Welcome to Commercial Real Estate Now. I'm your host, Carly Iacono. Today, I am so pleased to be joined by a long-term friend and industry colleague, Todd Pajonas from Legal 1031 Exchange. Todd, welcome to the show. How are you today?
Very good. Thank you. Thanks for having me.
Good to see you. We have been talking about 1031 exchanges together for well over a decade now. I did the math on the way here and I'm like, maybe 15 years. It's been a long time.
Don't age us too much.
Yeah, it's been a long time. We just thankfully look the same. Businesses,
Sure.
Nothing ever changes. We're just
Absolutely.
Continuing our mission here. So good to collaborate once again. Before we dive into some kind of interesting 1031 exchange concepts, bonus depreciation, some really relevant and timely topics, why don't you lay the stage for us a bit and tell us about your role as president of Legal 1031 Exchange and a little bit about the company.
Sure. Happy to do so. So I'm an attorney. I founded Legal 1031 18 years ago with my partner, Matt Sheriff, who's a CPA. We started really as a kind of a two-man shop and have grown. About 8 years ago, we merged with the largest title company in the United States, Kensington Vanguard, and then Truist, which is the eighth largest bank in the United States, about 3 years ago, purchased Kensington Vanguard along with us. And then last year, they spun us off into their insurance holding group called CRC Group, which is a $15 billion insurance holding company. So we're a small company attached to a big company attached to a $15 billion company.
Interesting. So your core business is acting as an intermediary.
That's all that we do.
Right. Now, why does your relationship to the larger companies carry weight? Why would that be important to a client or investor?
Sure. As a qualified intermediary for 1031 exchanges, we really have three jobs, if you will. One is there's paperwork that is necessary to properly structure a 1031 exchange. So we prepare that paperwork. Two, and more in line with what you're asking, is we hold the money in between the sale and the purchase. So you want to make sure that the qualified intermediary that you're working with is financially sound, has large backing behind them. So being owned by a $15 billion company, having $50 million fidelity bond, $100 million errors and omissions policy, hopefully gives all our clients that comfort. And our last job is really kind of what we're going to do here today is explain things to our clients. We can't give tax or legal advice, but we can explain and give them all the information and handhold through the transaction.
So it's really twofold. It's unpacking complex exchange issues, of which there are many that you and I have talked to clients about together, but also the stewardship, fiduciary responsibility, I guess you could say, of holding their money during the exchange. And we're not going to finger point, but have there been issues where intermediaries did not protect the exchange funds in the past?
Sure. And it's funny, there's 2008, and then there's before 2008, after
Right.
2008. Before 2008, people just send us money. They didn't really ask questions, didn't
Wow.
ask any due diligence. It is amazing. Ever since 2008, where kind of the bottom dropped out of the whole economy, but especially real estate, people ask a lot of questions, and as well they should. I always tell people, sometimes people are a little reticent. They're like, what they want to ask me is, how do I know my money's safe? But they're trying to be polite about it. And I always, once I know where the conversation is going, I said, look, you should know where your money is going and you should feel comfortable. Let me answer all your questions about that.
Mm-hmm. And being bonded and connecting to a large company is obviously another layer of security there.
Yeah, and we also work with some really large banks that'll provide trust services. So when we're working, especially with large dollar transactions, REITs, private equity firms in the hundreds of millions of dollars, we employ trust services. So that money sits outside of the qualified intermediary in a special trust account. We do that for lower dollar transactions as well.
Interesting. All right, so let's move on to really some more of the nuances of the current tax climate, exchanges, et cetera. And we're going to skip ahead we're going to bypass all of the basic mechanics of 1031 exchanges. So if anyone listening is wondering how to do an exchange or looking for ID rule information, some of the basics, we can certainly help you, but that's not how we're going to spend our time today. So we're going to fast forward and assume our listeners know and understand the basics of 1031 exchanges. Let's talk about bonus depreciation, because this has been a very hot topic with the new administration coming in and changing some of the tax laws. Lay out where we are with bonus depreciation and how that's relevant when we're talking about 1031 exchanges.
Sure. Well, bonus depreciation, it really got its start in the Tax Cuts and Jobs Act in 2017, and it was phasing out over time. So it was actually phasing out this year. And then July 4th of this year, the Trump administration passed what's called the One Big Beautiful Bill, or
always makes me laugh every time. You can't make that up.
Yeah,
right?
Somebody actually referred to it as OB3.
Okay.
And I was like, I like that. I think I'm going to use that from now on. So OB3, One Big Beautiful Bill,
Yep.
made bonus depreciation permanent. And so it by bonus depreciation, instead of taking depreciation over 27 and a half years for, what we would say is residential property, non-commercial is the way they phrase it, or 39 years for commercial property, you actually get to depreciate in the first year all of the real property improvements. So it is just, boom, you get all that benefit in year one.
Now, why would that be a relevant piece of the 1031 exchange discussion? I know, having gone through it personally and with clients, but lay that out, that this is not a siloed conversation where we talk about exchanges and we talk about depreciation and there's no, overlap. So why is the bonus depreciation discussion so tied to 1031 exchanges?
Sure. It really helps drive the market in much the way when cost segregation became a lot more popular. I want to say almost 20 years ago at this point, where people could accelerate the depreciation. It kind of drove a little bit what they were buying. So for 1031 exchanges, when people are coming out of assets that they still have a depreciable adjusted basis, so they still have basis that they're depreciating over time, and they want to get more out of that, or they're going to exchange into a property and leverage up, which will create new basis. If they go into these type of bonus depreciation properties, and generally they're car washes and convenience stores where more than 50% of the income comes from petroleum, gas sales, there's these huge benefits, and they kind of sit in two different buckets, which are real estate professionals and non-real estate professionals, kind of get two different levels. So it's a type of property where not only are you buying an asset that's cash flowing, but the main reason for buying it is these tax attributes that create losses.
And if you take the bonus depreciation, you're sort of front loading your depreciation, you could end up with a very low basis in year one, year two. So if you have virtually no basis or a low basis, and then you go to sell, I think that's where, correct me if I'm wrong, the exchange piece becomes so crucial, right?
Right. So if you buy a property, let's give an example. You buy a property for $5 million and you take all the bonus depreciation in 1 year. You don't depreciate the land. So let's say on a $5 million purchase, maybe you've bonus depreciated $4 million worth of value. Now your basis in that property, and you can't even depreciate it because it's attributable to land, is just $1 million. So you have a $4 million gain almost instantly. And then
Even if you sell that for no actual gain on paper, right? If you sell it for the same price that you bought it for, you still have a $4 million gain for tax reasons.
Right. And that's a really good point that people forget about. There's two different ways to get gain. And most investors have both. One, your property goes up in value. We all recognize that as the normal path to gain. And the other is by taking depreciation, which lowers your adjusted basis. So normally people have both of those.
Right. And really the only way to defer your capital gains, which would be significant in that scenario, is with a 1031 exchange.
Right.
So bonus depreciation has a lot of front-loaded benefits, right? A lot of cash savings, huge income boost at the beginning, but you could end up with a very low basis, and then really you're most likely going to be doing an exchange. So I think that's kind of where they're tied together. Talk to me about the cost segregation piece. So you mentioned gas stations, but it doesn't have to be a gas station or petroleum based property to enjoy bonus depreciation. Where does cost segregation fit in?
So cost segregation is you hire a cost segregation company that is basically usually a whole bunch of different trades. There'll be architects, there'll be tradespeople, accountants, and what they do is they look at buildings and they pick apart the different components of the building. Is there different type of lighting or things that are not necessary for the actual structure of the building, and then they'll depreciate those on a different schedule a lot quicker. When it comes to bonus depreciation, they're the ones who are going to a lot of times look and make sure that the property that you're looking at qualifies for that. Like in the case of a gas station, it also can come down to square footage and percentages given over to the convenience store versus the gas sales.
So, am I right that you can still take bonus depreciation without doing cost segregation, but the allocation won't be the same to shorter depreciation life
I think I,
categories?
I think a lot of the properties that are sold, the sellers and the developers know what they're doing, so they come with that information, which is the only reason why sometimes people buying them don't actually do their own cost segregation study. But if you're buying a property that maybe is already out there and you're not buying it from a developer or somehow that information isn't available, then they'll look to do a cost segregation study.
So you can really take advantage of that bonus depreciation clearly.
Right.
And and to your point, this is a separate professional, separate industry. Typically, it's not the client's primary accountant, right? It's a different profession altogether.
Yeah. There's, I've seen accountants look and do cost segregation as a generality
Okay.
based on a property type. Everything's correct until you're audited, but most people want that detail in their file. That way, if they're unlucky enough for it to be looked at, they have the detail that will provide the defense.
Security. Right.
Yes.
Exactly. So we understand bonus depreciation can lead to low basis, which is driving the 1031 exchange market. Is there any discussion about phasing it out? Or is this at a permanent 100%? Where are we today?
Yeah, I think that this is something that's the difference between the Tax Cuts and Jobs Act and OB3 is that it kind of made this permanent. No matter where you are in the country, you can't help but notice all of a sudden there are these bright, shiny new car washes all over the place. These, huge convenience stores attached to gas stations, and that's what's driving that market. So I think unless and until somebody makes a change, that's going to continue to grow that marketplace.
Interesting. All right, let's move on to common misconceptions on the 1031 exchange. So I have some ideas, but why don't you kick us off with something that you see often misunderstood when clients are starting an exchange that you wish was more broadly understood?
So I would say even more so, I could start off with an easy one, which is the concept of like kind. People hear like kind, you have to buy like kind property, and they think, well, I'm selling an apartment building. Like kind must mean that I have to buy an apartment building, and of course, we know that like kind really means any kind of business or investment property.
Which is quite broad,
Yeah,
actually.
yeah,
And just pause for a second. Anything held for investment purposes, really, right?
yeah,
It's quite a list. Okay. Go on.
yeah, but I would say the number one misconception really is this is the tax nerd in me talking, but the calculation of gain. People don't even realize their tax liability when they sell, which is what yields a bunch of last minute exchanges when they finally talk to their CPA. And even the calculation of gain, a lot of taxpayers think, well, I sell, I pay off my mortgage, I pay my broker's commission, I pay my attorney's fees, I pay all the transactional costs, and what's left over is my gain. Now that's net
Yeah.
cash,
Yeah.
and that's something completely different. So people don't even understand sometimes financially where they are with their investment and the tax liability that they may uh, recognize when they sell that property.
So first step is speaking to your accountant and understanding what your gain would be. And I would say even beyond that, speak to your qualified intermediary, identify one early and understand what is an expense as part of an exchange and what is not, because no disrespect to accountants, but sometimes I find the ones that aren't as plugged into real estate don't always know that answer.
Yeah, it's true. There seems to be some accountants that are more tax oriented, that all they do is tax returns. And then there are ones that are very involved in businesses and real estate. And to be fair to them, what I always joke about is they have to know this much of the tax code and I have to know that much.
Right.
So it's nice that they rely on me. But the very strange thing that I found out right away when I got into the qualified intermediary industry 27 years ago is I thought my number one referral source was going to be accountants. Because of course, everyone, when they were deciding to sell, that would be the first conversation. And no, people, they're going to make this major financial decision and they sometimes speak to their accountant last.
I see that all the time. I find that they call the brokers first. What's my property worth? Should I sell? And as we're walking through the evaluation, we're walking through what they're going to do next. We always bring it up. Well, what's your basis? What does your accountant say? Can you shelter any of this? What's the rest of your financial picture look like? And how are you handling this gain if you don't do an exchange? And they said, oh, I'll speak to them when we figure out what we're going to do. To which I say, well, no, I think you should speak to them now so we can kind of factor that into the evaluation because it is a big piece. But you're right, it's not usually the first call, and it probably should be.
Yeah, and I think also there's kind of two buckets of real estate investors. There's what I call real estate investors and then incidental real estate investors. The real estate investors are the ones buying net lease, buying apartment buildings, buying industrial property and managing them and rehabbing them and building them. And then the others are they own a business, like maybe they're a plumbing supply company or a restaurant. They don't consider themselves a real estate investor, but many times, decades later, when they're ready to retire, the one items that's worth the most money is the real estate, but they never considered themselves to be a real estate investor.
That's such a good way to look at it. It's true. I mean, if you own real estate for the purpose of business or investment, you are a real estate investor. So you should be educated and considering your assets as such. Good point. Talk to me about partnership structures. So this is a complicated one and something that we try to get ahead of again when working with clients because it's very difficult to make changes on the 1 yard line when you're selling a property. What partnership structures create the most complications for 1031 exchanges, and when and how do you address those?
Sure. So what we're really talking about when we talk about this subject is the same taxpayer rule. So the 1031 code and regulations require, with very limited exception, that the taxpayer that's selling has to be the same taxpayer that's purchasing. So what I always explain to people is if you're a partner in a partnership or a member of an LLC taxed as a partnership, or even, we can go further afield, a shareholder in a corporation that owns real estate, you don't own real estate. You own an interest in that entity, and that entity owns the real estate. So if that entity sells and you're one of, say, 3 members, then you want to exchange by yourself, it's not the same taxpayer on both sides of the transaction. So the lead-in question that you gave me is, how do you get ahead of that? Well, when you talk to people and you find out groups of investors that they want to go their separate ways, what we have to do is something that we refer to in the 1031 community as a drop and swap, which really means dropping out of the entity by dissolving it. Everybody becomes a tenant in common, which means they become a separate owner of the same property. And then the swap component is the 1031 exchange. So if everybody is together in this partnership entity or an LLC, then they have to remain together. If they want to go their separate ways, then a dissolution is generally the easiest way to handle it. Sometimes there's partnership buyouts on the front end. Sometimes there's a dissolution on the back end, so it can be a swap and drop. It's probably on most days at least a third to a half of what I discuss with clients.
And when should people start looking at their partnership structure? Because, part of the challenge I see is all the partners don't know what they want to do with the proceeds upfront. So it becomes a tricky situation. I might want to, one partner might want to exchange, they might not. We know one wants to cash out, we know another one wants to exchange. So if everyone's not sure what their goals are after yet at the front end, when do you start speaking with them and what's the right way to approach that?
As early as possible. As early as possible, probably even before you make the decision to sell. What I would say is that's the one conversation that even before they start talking to you about, what could I sell this property for? What's my valuation? What's the market doing? Even to get ahead of that, because then if they have this process ahead of them or something that's going to hold them back, what good is that conversation with you at that point? At the very least, it should be simultaneous. The worst time is they sell it, it's teed up to sell, and then at the very last minute they say, "Oh, by the way, we'd like to go our separate ways."
Right.
And it's not too late. It just makes the conversation more difficult.
Right.
Is all.
And is there just broadly, and this is hard to answer because every situation and deal is unique, but is there a structure that's more flexible? Let's say you're a new investor, you've got a few siblings, you're all investing together. Is a corporation, an LLC? What's it, tenants in common? Is there one structure that offers more flexibility down the road that you would recommend starting with?
Sure, tenants in common. To buy as tenants in common gives everybody flexibility. Let's say you and I wanted to buy the building that we're in right now. If we bought it as an LLC, which would be what most attorneys,
Standard.
accountants
Right.
would recommend, it would be the easiest. It would be taxed as a partnership. If eventually we want to go our separate ways, and it could be for a variety of reasons. It could just be different points in life. Maybe you're starting to pay for college tuition, and I'm just ending, things like that. So, and then with families, a lot of times it's who's getting along with who. Tenants in common, conversely, allows when you sell, we're ready to different taxpayers that own this property. If we choose to exchange together again, we can do that. Maybe you want cash and I want to exchange, or vice versa. Or maybe we both want to exchange, but we have different ideas about what we'd like to buy. So we go our separate ways. Tenants in common, if you can buy properties, tenants in common, that's always the easiest. You can't always do it, especially the larger the group of tenants in common, the less likely a bank is going to be to loan to you, because they want somebody in charge. So if you have like 6, 8, 10 tenants in common, bank is going to be a lot more reticent to loan to you. So many times kind of forced into an LLC and have to work it out on the back end eventually when that property trades away.
Is there some sort of layered structure where you have one entity for the purposes of lending, borrowing, and then you have a substructure that allows people to go separate directions?
Not really. What you'd find is within the tenancy in common, a lot of times people think a tenancy in common means that you have to own the property individually. I don't know where that thought comes from. I just bring it up that it pervades. They're like, well, I don't want to own it in my own name. No, it's, again, going back to the example, if we own this building together, you could have your LLC, I could have my LLC that own as tenants in common, or more so, I could have an LLC that maybe has other family members in mind owning as tenants in common with you. So just because it's tenants in common doesn't mean it has to be an individual.
Interesting. Okay, so you still get the protections of the LLC rolled up to a tenants in common, which is almost, is it a percentage ownership structure then? Okay.
Yeah, absolutely. And that's part of what defines tenancy in common versus a partnership. Like, let me tell you another way that people go wrong. Let's say we own this building 50-50, but I live in Connecticut, you live in New Jersey, and you say, I'm going to manage this property. One of the ways that sometimes you inadvertently form a partnership, even though you're tenants in common, is we're going to distribute 60% of the income to you and only 40% to me, even though we own 50-50, because you're going to take care of the property. We've just created a partnership, even though our deed says tenants in common. The correct way to do that is to collect the money, create a management company where we collect all the money, and then you get a management fee, and then we get a partnership distribution 50-50. That preserves our tenancy in common and prevents us from becoming a partnership.
That's fascinating. And my guess is more people don't do this on the front end because it's just a little more complicated to set up and structure legally. And then, like you said, you have some lending challenges. I mean, those are real concerns.
Yeah.
Um,
What I always tell people is, in most cases, even the least expensive real estate is hundreds of thousands of dollars, if not closing in on $1 million. What can you buy these days, sadly, for less than $1 million, right? I always tell people that every once in a while somebody will say to me, I'll say, we need to do drop and swap and this. And they go, it seems like a lot of work. I said, well, if you don't do a 1031 exchange, you might have a tax bill in the millions of dollars. How long did it take you to earn that money that you're just willing to say, oh, I guess I have to pay that because it seems a little complicated. And by the way, it's not that you, the taxpayer, have to do the work. You just have to hire the right team of professionals to see you through. And net, you're going to save hundreds of thousands, if not millions of dollars for that effort.
that is such a good point, right? And I think people do lose sight of how much money they're spending and what it took to earn that and to get to where they are. And they're hesitant to hire a professional for whatever it may cost, a fraction of the cost. I see this a lot in due diligence. I'm shocked when clients say, I'm not going to run a phase one that's $2,000 or $2,500. I'm sure it's fine. I'm like, no, you need this protection, right? That is nothing in the grand scheme of what you're buying and what you've built here. So you really shouldn't cut corners for things like partnership structuring, tax advice, legal advice, finding the right intermediary, running your due diligence. It's all part of it.
I totally agree. And it's amazing how often it does happen.
Right. So don't do that to everyone listening. We're telling you right now, be smart investors. Okay, good. That was very interesting on partnership structures because that's something that we hear come up a lot. So the takeaway there is have the conversation early. If you already own the property and you're not just starting out as an investor, really talk to your professionals before you consider selling. Figure out what you want to do within your ownership entity and what you can do to change the structure if necessary before going to market.
I would totally agree.
Sounds good. Let's move on to some state tax implications. So we have the 1031 exchange, which is recognized federally, right? How do states look at exchanges and is there variability state to state?
So pretty much every state now recognizes 1031. Pennsylvania was one of the last holdouts until now. I think it's a couple of years ago they finally signed on. So you can exchange state to state. Really, the variations occur with the actual transactions, sometimes the reporting, sometimes the withholding. Like I'll give you an example. New Jersey. We're sitting in New Jersey right now. And if I'm a non-resident of New Jersey and if I own this building, metaphorically.
I think you want to own this building.
Yeah, I'm using it. I'm using it as an example.
It's a lovely New Jersey office building.
It's a nice building. And I'm not a New Jersey taxpayer and I sell. New Jersey says, hey, I want to make sure that I collect the tax from this guy because he's a New York taxpayer. And if we just let him take all the money from this transaction, we may never see it.
Right.
So New Jersey and other states like right across the river, New York does the same thing. They want the estimated capital gains tax at the closing. But if you're doing a 1031 exchange, then you don't have to pay that estimated capital gains tax. So New York and New Jersey are very similar. There's other states where if you're a non-resident, you would have to pay the estimated capital gains tax. And then you can go to the extreme, which is California. Of course, California is going to be an extreme in terms of taxation. Mm-hmm. If you are even a resident of California or a non-resident and you sell and you structure it as a 1031 exchange and you're buying outside California, California requires you every year to file a tax return to report back to California that you haven't sold that property and recognize a gain. Because if you do, 1 year later, 5 years later, 10 years later, California is still there saying, you owe us our tax. So they follow you through the rest of the transaction. So that's a little bit of nuances of the state level. It's more, the nuances really occur with their want and desire to collect the money eventually from the taxpayer.
Got it. So you can defer taxes both federally and state now in every state in the US, right? Through a
Correct.
1031 exchange, thank goodness. But when you stop exchanging, that's where the states are still going to come calling.
They want their money back. Yeah, because California, actually, as crazy as it sounds, is actually doing it correct. You're in New Jersey, you're a New Jersey resident, you own New Jersey real estate, you sell one day, you exchange all your property down to Florida, then you move down to Florida, you become a Florida taxpayer. 10 years later, you decide to sell one of those assets. Do you tell New Jersey?
No. Am I supposed to say yes? I mean, this hasn't happened
New
yet.
Jersey
so-
would, like, depending on who the new governor
who's
is going to
listening?
be,
Do I say yes?
wants you to say yes, but I think most people say no. So
That wouldn't occur to me, to be honest. Like, not trying to be, elusive here, but that wouldn't occur to me years down the road that there would be an obligation from the original
and
state.
yet there is.
Wow.
And so whether through not realizing it or saying, hey, I got away with something,
Mhm.
that's why California tracks it.
Is that the only state that you know of that tracks it that closely?
That is the only state I know of that does that. But I wonder if we'll see more states go along with that as well.
They just tighten up and try to pull in all the tax dollars they can.
Well, it's an interesting point because whenever we talk about 1031 exchanges or taxes in general, everybody always talks about the IRS agents getting audited. What most people don't realize is all the state taxing authorities are way more aggressive than the IRS. So while we all talk about the IRS like the boogeyman, it's really New Jersey Department of Revenue, New Jersey Department of Revenue, California Department of Taxation and Revenue that is the more aggressive of the taxing authority that taxpayers should be concerned with on a certain
I
level.
wouldn't have thought that. So do you think more audits then are started by the states than federally?
Well, proportionately to
Okay.
each state, yes, I would agree. And the bad news is they talk to each other. So if the IRS finds something, a lot of times they'll tell the state, and the state finds something, they'll tell the IRS. So once you're hit with one, you kind of get a double whammy. But still, and this was something in the last administration that came up, that they were looking to hire all these IRS agents. The incidence of audit is very, very, very low. I've been acting as a qualified intermediary full time for 27 years. I can still count on my fingers the number of times my clients have been audited. And of those, 1031, like I think it's up to 7 or 8. And I'd say the 1031 exchange was the driver in only 2 of them. In other cases, it was expenses or businesses, they owned a cash business or gifting. There was something else that drove the audit. So think about that. In the tens of thousands of transactions I've been involved in 27 years, 2 of those have been because of a 1031 exchange. That's
because it's
crazy.
it's a verified legal process, right? And you're checking all the boxes, you're doing the right thing, but still, those are fantastic numbers. Good job.
It's not, well, I wish I could take credit. It just means
all
that
your structure.
Oh, yeah,
No.
Absolutely. But it is something to factor into the conversation.
Right. And you do want to do everything right because you don't want to be one of those 2 in 27 years. So, everything we're talking about with checking all the boxes and going through the motions correctly is very, very important because you don't want to be the 1 or 2 audited. But
Absolutely.
it's good to keep it in perspective as well, that this is something that's done all day by thousands of people and usually very, very smooth.
Yes.
Let's move on to reverse 1031 exchanges. This has been a very small part of my business. I would say 98% of clients seem to do standard 1031 exchanges. But as the market tightens and it's a little trickier to get deals done, especially in the last 3-4 years, things have been just a bit more challenging in capital markets. This has come up more and more. So because it's not as widely understood, why don't we start a little more basic and give the audience the benefit of basic understanding of what a reverse 1031 exchange is?
Sure. Absolutely. So a reverse 1031 exchange is kind of what it sounds like, which is you're structuring the 1031 exchange in reverse. Most 1031 exchanges, you said 98%, I might even go as high as 99 point something percent, are forward-moving exchanges, what we refer to as deferred exchanges. The easiest, most common, the most cheapest to structure. You sell first, and then you use that money to buy. In a reverse exchange, you're buying first, and then you're selling. And just like a forward moving exchange, you have 180 days in which to complete that exchange. In a reverse exchange, from when you take title to that new property, you have 180 days to sell. So everything is just in reverse.
How does that work in practicality?
Right. So in a
I know it's more complicated.
yeah.
Yeah.
So the taxpayer is actually not allowed to own what they're selling and what they're buying at the same time. So a reverse exchange is also referred to as a parking exchange, because what's going to happen is the qualified intermediary, or more properly, an entity that we form called an exchange accommodation title holder, which is really just a fancy name for forming an LLC that's acting as a straw man. We're going to form this LLC, and let's say you're the taxpayer that wants to buy this building.
Can't wait.
And you want to buy it. You know you're going to sell something, but you haven't locked up that deal yet. But the seller for this building says, got to close on this before the end of the year, right? So we form this LLC, and what you have to do is you have to fund that LLC. You haven't sold yet. So that's one of the biggest challenges. You have to have the financial wherewithal, whether it's cash or a lender, generally a combination of both. So you would loan the equity piece towards the purchase, maybe arrange some financing for this LLC. And the LLC that we control as the qualified intermediary would buy the property for you. And then during the period of time where we're on title and until you sell that other property, we would enter into a management agreement. That way you would have use, control, occupancy of this building during that period of time. So you operate the building. You're just not on title. Then when you sell the property to pay for that, that money comes back, and the money that was lent to purchase that property gets repaid, and then we transfer the membership interest in the LLC to you to complete the exchange, and then you own that property.
That's it. All right. I don't know why we thought this was so complicated. I mean, come on. No, I'm kidding. I'm kidding.
There are a lot of moving pieces.
For sure.
Have to get the lender comfortable.
That was my question. What lenders are excited about this?
Right.
I mean,
so the funny thing is, and again, I've been doing this a long time. Years ago, every conversation was like a new conversation with the lenders, and I'm going back like 20 plus years. Now, even the smallest of savings and loans, credit unions are wise to this, have done reverse exchange transactions. What's nice about the small banks and credit unions is that you can get a hold of somebody who kind of is in charge.
Right.
And the larger ones tend to be more sophisticated and know about this already. So the odd thing is that it really is not a barrier of entry for the reverse exchanges anymore like it was years ago. Lenders are pretty much on top of it, because at the end of the day, the lender is getting what it bargained for. Even though we're on title as the qualified intermediary, we're going to sign the mortgage, so they get a security interest in the property. We'll sign a note. It's non-recourse to us because we're not going to be your partner in this deal, so we don't want any of the liability. And then whatever kind of personal guarantees you might have given, personal or business guarantees, corporate guarantees, you'll sign that in a separate document. So the bank gets what it bargained for: a security interest in the property, whatever kind of guarantees that you have negotiated with the bank.
So from the lender's perspective, this could be a straight purchase, right? They have the asset as collateral. They have the personal guarantee if it's that kind of loan. So it doesn't really look a lot different to them.
Yeah, the only transaction where the lenders are to go the opposite extreme, a huge problem, is with purely residential transactions. So we deal a lot with, even though we're talking about buildings and industrial and especially retail, we do a lot of that. But also a segment that's often overlooked as not being investment property are rental homes. We do a ton of rental homes, whether it's the Jersey Shore, the Hamptons, Virginia Beach. We do a lot of that. And a reverse exchange for those are problematic because there you're dealing with residential lenders, and they want the loan to be conforming. And if we take title to it in a reverse exchange, it's not conforming. They can't sell it the next day to an investor. So they tend to balk at those transactions. So investors who want to do reverse exchanges of a house, a condo, or a co-op with a residential financing, I'm not saying that you can't do it. Cash, if you have the cash to fund it yourself, that's the easiest. If you can borrow against another asset, that's the easiest. If you have to deal with a lender, a lot of times that's problematic.
Interesting. Okay. So we kind of went through the financing piece. If you have the money and you can fund this upfront transaction and the lender will approve you, I guess really you would have two loans simultaneously then if you're financing it, right? So if you have the means to qualify for both loans at the same time or you're funding it all cash, we can get around the lending piece. What if the property that you are selling doesn't sell?
Unfortunately, that happens every once
Right.
in a while. As a matter of fact, I used to work with a very large, I'll phrase it this way, very large hamburger chain, which was a franchisee of a national group, and they owned thousands of these hamburger stores. They would set up every purchase as a reverse exchange and then try to sell. And sometimes they just wouldn't sell. But it all worked out because they said once they completed one exchange, the tax savings on that probably paid our fees for the next 30 years, right? Just
Mm,
one transaction, what
right.
they saved. So in a reverse exchange, if you don't close on the sale within 180 days, what happens is you just wind up owning the property that was parked, the first property that you purchased. And now when you sell that property, if you're still looking to sell that property, you can still do a 1031 exchange. You just can't buy the property you already own because 180 days have
Mm.
passed. So you can sell and buy whatever other property you want, just not any property you already own.
Because that's one of the basics of 1031 exchanges that I hear a lot too. Can I exchange into a property that I own or I have under contract
Or my
already
spouse,
or
or
my
my kid.
partner?
Yeah,
Right,
yeah, and or I own this one in one LLC and this one
right.
in a different LLC. Can I exchange those properties? And the answer is generally no. There are related party transactions, which this podcast would go for another
3
few
days.
hours. Yeah, and it's very very boring. But you can't exchange into your own property.
Right. Okay. So if you run into the situation, to recap, with a reverse exchange where you've bought your first property, you've parked it with the LLC that we discussed, and you go to sell your primary property, it does not trade. You now own two properties and you can still exchange the property you were going to sell, but into something different. So you now have basically a bonus property, which
Yes,
could work out if you're financially able and you loved that first property, or it could be a real problem if you were counting on those proceeds.
that is true. That's
So
why I
it's one of the
reverse.
risks,
Yeah,
right?
exactly, exactly.
Interesting. And do you think it's that reason, right? Just sort of the risk of the timing of everything, or is it complexity? Why do most people stick with the forward exchange? Why don't we see more of these?
I think it's the money component, the cash
Mhm.
component, having the capital up front that you don't have yet from the sale to be able to make the purchase. The majority of our reverse exchanges, or at least a good portion, are well capitalized real estate investment companies that are doing the reverse because they want the surety of being able to sell. They feel that they can control the purchase more. Think about it: the purchase, well, you have to. I'm sorry, the sale. You can control that more. All you have to do is lower the price a lot more. You're in control of it. There's a certain point at
Right.
which
Where it
the
will
fish
sell.
will start biting,
Right.
right? So you're a little bit more in control of that than competing with other people to buy the property. So that's the reason why a lot of these companies do that.
Interesting. So, after all of that good knowledge, my guess is this remains a very small part of the market overall.
It is, but it's in terms of as a qualified intermediary, it's an outsized amount of work. We have
I'm sure.
our general counsel who has an LLM in taxation, which means he went to law school 2 more years for tax. He heads our department to do that. And we have another counsel who works with him. And my partner and I also get involved in these transactions. There are a lot more work. And that's one of the funny thing is, again, you brought it up where people say, it seems like a lot of work. And I always tell them, I said, a lot of years ago, I had surgery on my shoulder and I asked a bunch of questions, but I didn't have to do the surgery. So it's good to understand
Right.
what's going on. You should ask questions, but a lot of times I'm like, you don't have to do this work. That's what you're hiring us for. So
Right.
it's great. Ask questions. I'm here to explain, but you're going to give us a little bit of money compared to all this money that you're going to save in taxes. So sure, it's complicated, but use makes master, and we're good at this. We're used to it. So just hire us, and we're going to save you that money.
Isn't that always the case, right? Finding the right professionals takes the work away. That's the
Yes.
point of having qualified people around you, which I think gets lost sometimes in our high tech world, right? Find the good people, have those relationships, and then everything becomes a lot easier, even if it's exceptionally complex.
Hmm.
Anything else you would like to share? Any misconceptions, misnomers, any other advice on 1031 exchanges before we wrap up?
So I would really just say that education is your friend, and you just said it right now. The professionals that you surround in the transaction make a huge difference. One of the most common questions I get asked is, how many people fail their exchange? In other words, don't complete the exchange and have to pay their tax. And I would say, well, it's an interesting question because I shouldn't answer it as a percentage. I should answer it as the type of person that I'm involved with in the transaction. Those who work at it like a business, that hire the right real estate broker, that hire the right attorney to be self-serving, to hire the right qualified intermediary, when they surround themselves with professionals that know their roles and are very competent, the success rate is very high. You still have market dynamics and control, but those who wake up on kind of the day before the closing, decide to do a 1031 exchange, they have Uncle Al as their CPA, and they have an attorney who does wills, trust, parking tickets. That's not the winning team.
Right.
So I would just say, kind of in closing, is surround yourself with the right professionals, and it gives you a much better chance of having a successful transaction.
That's really the easy button. That's the hidden easy button in a very complex topic is find the right people and everything else falls into place. Todd, this has been fantastic. Thank you for sharing your wisdom. I think we covered a lot of really important, timely topics today, and I'm so happy you could join the show.
I appreciate being here. Thanks very much.
To everyone listening, that was this episode of Commercial Real Estate Now. We're so happy you tuned in, and I look forward to seeing you again very soon. Have a great day, everyone.